Hello and welcome to BQ Prime. You're watching Talking Point, and my guest today is Dhananjay Sinha, who is the Director and Head Research, Strategy and Economics at Systematic Group. Dhananjay, thank you very much for joining us on BQ Prime. Let me start with the earnings season, how it has fared so far. The street seems to suggest that earnings season was better than expected. But there is a mixed view coming as well, which says that the growth was not homogeneous. What is your take on it?
So I think broadly, what is happening is that the earnings season essentially has been characterized by sort of a slackening as far as the overall top line growth is concerned. So if you look at the aggregate non-finance companies, so the sales growth has actually decelerated to something like 8% 8.5% from something like 15% in the previous quarter year on year. And what we find is that a lot of these companies in the manufacturing and services space have actually focused a lot on conserving margins and stuff. So they are scaling down their operating costs and also raw material requirements. And as a result of that, there is some upside that has happened with respect to the margin. So I think in the overall scenario, it does look like that margin expansion in select industries have had a disproportionate impact on the overall profitability and profit growth. So I think you have a mix of slowing top line and conservation of raw material operating costs. Also, there is a sort of a slowdown as far as the compensation growth is concerned. So that's for an aggregate at an aggregate level is growing at 4.5% or somewhere around 5%. So I think overall there does seem to be a slowdown, and companies who have actually gained market share, they have been able to conserve margins and stuff. And these are largely in the space of consumer space in autos, etc. There has been an expansion in margins and stuff. So I think that is what has been happening. IT sector had actually seen a bottoming out, but this quarter has seen a sort of a disappointment out there. So I think it's a mix of things. As far as the banks are concerned, banks have seen a good performance, especially at the net profit levels. But that has also been contributed by the fact that you have a sort of a reduction in provisioning, etc., which has been supporting. But at the operating profit level, there does seem to be sort of some amount of slowdown, largely because the working capital requirement of the non-finance companies actually come off quite sharply. So I think the lending demand for demand for loans from the industrial segments actually come down. So that essentially is sort of impacting the spreads and also the operating profits of the banking sector. So I think that's broadly the sum and substance of the earnings season has been.
So, if you look at some of the key sectors that was driving the earnings in Q4, financials, bank and financials, and auto sector. These are the two sectors which were largely driving the earnings, especially if you see the Nifty. How do you see these two sectors moving ahead? Do you see some kind of moderation happening in their growth going into FY24?
So I think as far as the auto sector is concerned, we have been fairly overweight and bullish. I mean, there are three reasons, three factors, and some of them have actually played out. So, for instance, number one thing that we had considered was the recovery in the volume which happened post COVID, etc. There was sort of a serious recovery in volume, but what we find there is that it is actually peaking out on a seasonally adjusted basis. That is actually coming down now. So I think the volume for let's say two-wheelers and passenger cars, etc., have actually peaked out. I would say that even for commercial vehicle, it is actually the best is behind. So I would say that year-on-year growth is actually decelerated, but on a seasonally adjusted basis, these volumes are actually coming off. So I think one part of the auto space, which is like recovery in volume, has actually played out. Second part was that you have an improvement in average realization for the vehicles sold, largely because of value addition, etc. and as a result of that, there was increase in operating profits and margins, etc. So that has also happened. Third thing was the margin expansion. So the margin expansion was expected because we thought that there will be a reduction in commodity prices, etc., and that should start impacting the margins and stuff. So I think that has been partial. I think it is panning out, and in the last quarter we have seen some of that playing out. We think that it can continue going forward. So broadly, I would say that of the three variables, two of them have actually played out to the entirety. I think the last bit, which is the margin expansion bit, is still to play out in a significant manner. So I would say that even in auto sector, we need to be selective about which segment we are in, which stock we are in. So wherever there is resilience in volumes, etc., volatility is lesser. Let's say tractor, for instance, is one area that we are considering. Where you can have resilience in volume, and you can have margin expansion, two-wheelers, etc. Some two-wheeler names we are sort of considering there. As far as banking sector is concerned, we are already seeing that margin compression is happening. If you look at the cost of fund, largely driven by the term deposit rates. So the term deposit rates have been hiked earlier on because of the lack of deposit accretion, and the credit demand was higher, credit growth was higher. So banks had actually stepped up their interest rates, etc. And what is also happening for the banks is that you have a shift from the CASA, which is like cash and saving, current account and saving bank account balance. Proportion was higher during post-COVID. So that is actually shifting towards term deposit as interest rates have gone up. So the mix of deposit is actually moved more towards term deposit. That is sort of impacting, that's resulting in a rising cost of fund. But on the other side, if you look at the lending side, there is some amount of slackness that is there. As I've said, with respect to industrial lending, and especially the corporate lending has actually gone away. So there is no demand out there, and there's huge competition as far as industrial lending is concerned. So that was one part that resulted in episodic rise in the spread for banks, but that has actually collapsed. Now, as a result of that, the margin pressure has actually come about, and what banks are trying to do is to really do aggressive retail lending and going to non-metro areas, to rural areas, to semi-urban areas, to younger cohorts, just to ensure that there is higher yield, etc. But I think that's not good enough to really resurrect the pressure on the spreads. So I think the pressure on the spreads are likely to continue going forward. We think that a demand for retail lending will also sort of come off, and we think that as banks have gone into lower quality sort of collaterals and stuff. So what is important as far as the overall retail lending is concerned, the mix of mortgage lending has come down from 56% in 2015 to 49% now, and people are doing much higher level of uncollateralized lending, credit card lending, loans against deposits, etc. So I think there is a mix which is changing towards low quality collaterals, and the profile of lending that is happening is also of a weaker quality. So I think of a shorter duration. So I think going forward, you might actually see some amount of increase in our bottoming out of the NPA cycle. So you can see credit risk, credit costs rising, and banks becoming somewhat conservative, and that will translate into a peaking out of the leverage benefit that the banks had because of recovery in lending growth. So I think you will have a sort of a lower ROE scenario. You might actually see higher credit cost and slow growth, because and that is also also visible that the spread is actually compressing, that the spread between the average lending rate and the average cost of fund, especially the term deposit rates, and the shift in the overall deposit towards term deposit, all those things will have a bearing on their profitability. So I think the episodic rise in profits that banks showed in FY23 are going to reverse as we go into FY24. I think these are the outcomes. Yeah.
So, we were looking at some of the lending rates, and on a blended basis, we are seeing some signs of rates, blended rates coming down for some of the banks.
Yes.
Do you see reversal of rates happening in this cycle? We have a policy today coming up in just a while. How do you see the
Yeah.
policy, looking at the entire overall scenario of growth as well as inflation and we saw the governor talking about a pause currently. Uh, do you think the pause will continue, or there could be reversal of interest rates going into second half of the year?
Our assessment of the economy, if you look at it, and the note that we have actually published in Bloomberg Quint, basically talks about the core growth, which is of the order of just 2%. So we know that the overall household consumption or private consumption has actually decelerated to 2.8%, and on a 3-year CAGR basis, been about 4.7%. So a good bit of good chunk of the economy or the domestic demand is actually slackening, and the ratio of total private consumption has fallen from something like 62% to 58%, almost like 500 basis point fall that has happened. And if you look at the balance sheet aggregates of companies, non-finance companies, we have seen that the year-on-year growth in the net assets has actually come down to just about 4.5%. So essentially, what is happening is that the private sector is actually, is slowing big time, and our estimate is that the a good bit of, let's say, about 82% of the total domestic consumption or total domestic demand is growing just about 2%, which is including household consumption and private investments and household investment in real estate, etc. So I think there is a considerable slowdown, whereas the headline number for the fourth quarter is about 6.1%. That's largely because the government has done a heavy lifting as far as capital outlay is concerned, and our estimate is that it could be of the order of 35% year on year for the fourth quarter. And also the benefit that we've got because from the fact that US and Europe are still not seen a recession, so there is support for services exports and exports in general. Whereas on imports, there is a fall or sharp deceleration because of the slackening domestic demand. So I think that's a net of the growth scenarios. I think if the RBI is to really look at the growth scenario while everybody is talking about very strong growth and rebound and all, I think it is illusory because the underlying demand scenario is fairly weak. So I think RBI will be in a dilemma to basically say that growth is good, but the underlying situation is bad, so it's not that great. So I think it's a dilemma for the RBI, and we know that the inflation is actually decelerated because of the fact that your domestic demand is weakened considerably, and there is some spillover effect of falling commodity prices as well. So I think RBI would want to support growth, but I think the fact that the fact that your global situation is still fairly tight, especially with respect to US and Europe, they might actually they might actually choose status quo. And if I look at going forward, I'd say that your demand for credit as it comes down, your market yields will kind of soften as it has already the yield curve is actually flattened. So I think that bias might actually continue, but the ability of the RBI to cut rates if growth weakens even further might actually be challenged because the global rates are going to be higher for longer. So I think you might actually see a flatter yield curve, unchanged policy rate for a long period of time. And that's how I look at the RBI giving guidance as well.
Dhananjay, if you look at some of the estimates coming in for FY24 after the Q4, surprise GDP numbers that came in, many of them have upgraded the GDP number for FY24 there. And if the underlying growth or the capital formation or private consumption, which you're saying is, it's weaker or feeble, do you see this growth rate, which everyone is now talking about, around hitting 7% in FY24, at risk, at least for now?
Yeah. I think we have said that such impulsions after the fourth quarter number could be hasty because the underlying quality of growth in the fourth quarter print, which is 6.1%, is actually weaker than the previous quarter. And it's consider see the point we have to really understand is that you're getting a 2% growth effectively of the private sector when the whole post-COVID rebound has happened. So what do you get after the whole fiscal stimulus and global bounties that has happened? As it sort of played out, what are we getting at the end of it? Because you've gone beyond the maturation of the recovery cycle, and you're getting at 2%. And going forward, we are going to see those factors that are supporting the growth at this juncture, which is largely global, is actually going to ebb because uh, if the US and Europe are going to get into a recessionary scenario maybe towards the end of the year or next year. So that the delta from the current scenario in terms of growth impulse is going to be weakening. Number one. Number two, the nominal GDP growth has actually decelerated to 10.4% or there about 10.5% from 17-18%. So basically what will happen is that your tax collections will actually get challenged. So the government's ability to continue to support through capex, etc., is going to be challenged. And number two thing that is very important to realize is that, notwithstanding the fact that the government has been pushing a lot of infrastructure spending in roads and railways over the last few years, it has not translated into the crowding in effect for the private sector. The private sector has continued to languish. So private sector capex has continued to languish, and companies are focusing more on automation, etc., rather than investing in plant and machinery. So which means that as impaired, then I would say that the demand scenario would continue to be could continue to be challenged. So I think it's a challenging FY24 that I see, and I think the upgradation that people have undergone just because they have seen a higher print for the fourth quarter, which I am saying is illusory, is a sort of a hasty view. So I think all those things will normalize as we go forward in the next year.
In putting all this in context, Dhananjay, how do you see the Nifty earnings going in FY24?
So I think if you look at the consensus estimates, people are expecting a 3-year CAGR of roughly about 14 odd percent. If you look at the consensus estimate, FY22 was 40% growth. I would say FY23 is roughly about 11 or 12% growth, and largely driven by some improvement in margin and stuff. With these kind of base and the fact that the economy is growing at 2% as a core. And I would say that if you look at the pre-COVID trajectory, the economy is 4% lower. If you look at the counterfactual, 4.5% growth prior to the COVID, and the consumption is about 10% lower compared to the counterfactual trend. So I think if you look at all these things, it's very difficult to get to 14% CAGR in the next couple of years as people expect. So I think downgrades will happen. I would say that it is going to be fairly flattish as we go forward in the next couple of years. So I think it will be more about composition of earnings. And I think where I think things can be better is where you have companies who have large market power, and these will be consumer oriented or B2C kind of sectors, and especially in the space of staples and FMCG, and as I said, mentioned autos and those kind of stuff that will actually gain prominence. Than I would say that deep cyclical sectors such as metal, capex, etc., all those things will be lesser. So I would say we need to really look at, and banks essentially I'm looking at that as a drag in overall composition. So I think it's the consumer space that will actually gain share in terms of the earnings composition, whereas the cyclicals will actually diminish. So I think there will be a shift, and overall growth could be lesser.
Dhananjay, in all this, you mentioned about the fact that there could be downgrades, but there are a couple of sectors which are already been, the street is assuming that it's not going to be a good year for them, especially IT, metals, commodities where prices are coming down, margins could be under pressure. IT, where we have seen a bad commentary coming in Q4, and some of the analysts are penciling in a bad FY24 for them going forward. Do you see these two sectors by any chance showing some kind of bounce back with respect to earnings and growth coming in?
So I think, see, we are, we are zero weight on metals, for instance, and sort of we are sort of underweight on commodities in general. So I think the underlying thought process is like this: that if you have a slower global growth and the kind of growth that we have with respect to India's economy and domestic demand, which is, as I said, is growing roughly about 2%. I would say that and as companies are actually reducing their raw material requirement, working capital, etc., it is quite likely that things such as commodities and all will be lesser in demand than in a scenario if the growth were actually stronger. So I'm saying that we are sort of positioned for a scenario where the demand for raw material, metals, etc., is going to be lesser. If you look at China, for instance, specifically with respect to metals and steel, there was a lot of hope that once China opens, there will be a flurry of consumption demand, and the problem with respect to the real estate, etc., will dissipate and all. There will be recovery in demand for metals, steel, and commodities, etc. But we have seen that enthusiasm has actually fizzled out, and the recovery in the real estate hasn't been as expected. And so I think the overall drag continues, and we have seen that China steel prices lower than the COVID lows. So I think there is likelihood of dumping of high quality steel into India, and I think the Indian prices are higher than the Chinese landed price. So I think there's going to be competition. So and that is also happening in chemical space as well, especially agrochemicals and stuff. The companies are facing competition in home appliances as well. That is also happening. So I think see the metal space and are likely to be under pressure, and material space generally. So I think it's important to really be on the side of sector that consume such raw materials. So those will actually benefit because of low prices of raw materials. So I think that is one. And the other one you asked about is IT. I think with respect to the IT space, I think we are sort of a little bit constructive while there are worries about a recession and stuff. But the cost pressure, especially with respect to labor cost in the US, is lingering. And despite the fact that US is tightened, etc., the unemployment rate, etc., continues to be very low out there. So the wage pressure is very high. From that standpoint, I would say that Indian vendors will still have a sort of cost arbitrage to benefit from, and that can add productivity to the US companies or companies in Europe. And if there is also an increase in tax rates out there, because I mean this whole talk about that is happening with respect to the debt ceiling and all. I think if there is an increase in taxes, there might be more outsourcing that US companies etc. might do. So I think that is a sort of a positive slant with respect to businesses for IT companies, and also the fact that the wage pressure that Indian companies were facing might also sort of come off. So I think all those things are there. But nevertheless, I would say I would share the worry that people have with respect to uncertainty, etc., with respect to when the recession happens and how does it impact various various companies and sectors and all those things are there. I think those will be also kind of an event. But I think structurally, it is imperative for it is an imperative for US and European companies and companies in the developed worlds to outsource more and more. So I think that's like a structural view. So I'm sort of equal weight on IT.
Dhananjay, it was a pleasure talking to you today. Thank you very much for joining us on Talking Point on BQ Prime. Thank you very much.